I'm Josh, I'm an investment researcher and a qualified actuary, and I've spent the first 6 years of my career researching the most successful hedge fund managers in the world. In this video, I'm going to run through 9 ways they became so rich that they questioned the meaning of life. So let's get into it. So the first thing that they did is they run huge amounts of money. So when you think of the biggest hedge fund managers in the world, you think of Bridgewater, that's currently managing 90 billion, Man Group, that's currently managing around 80 billion. That's also Citadel, they're currently managing 63 billion, and obviously Renaissance Technology is apparently managing around 40 billion. So these are huge numbers. And the benefit of running huge amounts of money is when you charge your 2% management fee on that pool of money, the absolute amount of capital that is obviously a huge amount. Also, a lot of hedge funds charge a 20% performance fee. So obviously generating 20% performance and being able to generate that on a larger asset base is obviously going to be way more profitable than generating that on a smaller asset base. So hedge fund managers essentially are employing one of the first forms of leverage that's mentioned in Naval Ravikant's book when he talks about leverage, which is leverage of capital, i.e. capital can amplify the decisions you make. So if you're skilled and you're making good decisions, the results are obviously amplified as well. Now this can work both ways. You can lose a lot of money very quickly using other people's money to leverage yourself, but yeah, that's the first way that hedge fund managers. And I've drawn a little diagram of the economics of that here. So you've got profit, and then you've got, say if you're running 10 million in assets under management AUM, and then you've got 100 million here, you're obviously taking 2% management fee on that amount, so your profits basically go up linearly. But if you introduce a performance fee, so 20% performance, then what you tend to find actually is your total profit would do something more like this, because over time, as you asset gather, your returns are going to be harmed because it's harder to generate a larger amount of return on a bigger pool of money. So this is the first way that hedge fund managers actually normally slip up as well, is that they asset gather, and they eventually have so many assets under management that they can't generate the returns, so the clients leave, and then this all just falls back down. So it's probably the first way that human brains actually struggle with non-linearities, i.e. they think that they can just keep gathering assets and this will keep going up linearly forever, but there's also this kind of limiting factor on that. So the second way hedge fund managers made so much money they questioned the meaning of life is they hired lots of other traders. So what you would typically find is hedge fund managers or a leader of a hedge fund group would spin out of an investment bank or start their own hedge funds and hire additional traders. So the head honcho or the head trader of a hedge fund would typically run the most capital, and then the other traders that came in would run smaller amounts of capital. The benefit of bringing on the additional traders is that they would have slightly different strategies. They would be diversified in terms of time horizon, or in terms of instruments traded, or in terms of just investing style, which meant that when you aggregated the return streams of all the traders together, there would be some diversification benefits, which meant that they could run even more capital, because there was normally a limit on how much one trader was willing to manage. So by adding additional traders, you could essentially do that equation again and increase your assets under management and therefore increase your management. This is another form of leverage that's mentioned in Naval Ravikant's book. So obviously we mentioned capital. This is the form of leverage which is hiring people to work for you essentially. So again, I think a lot of hedge fund managers would think that the equation goes like this, and it kind of does for a while. So your profit can increase because the 10 traders, you can generate a certain amount of profit, so you can run a certain amount of money, and then obviously with 100 traders, you can run 10 times the money and generate 10 times the profit. But what happens in actual fact is the diversification benefits typically dilute the return streams of the fund. Traders are obviously expensive, you have to pay them salaries, and they're difficult to manage as well, so there's increased costs there. So again, what you end up more like is something like that, so it kind of tails off. And this is another example of where hedge fund managers typically fall down, is because they typically start bolting on additional strategies, uncorrelated with the core return streams, but actually aren't that good, and that dilutes the overall fund return, which means the clients don't stick around, they leave, and typically if they've got performance fee structure as well, their kind of profit trails off. So this is another part of leverage, which if they manage it right, can work really well in their favor, but if they manage it wrong, it fails. And yeah, another reason why they're always tempted to just add that one more trader, that it could cause their profits to fall off a cliff. Now the third way hedge fund managers became so rich they questioned the meaning of life is that they added on algorithmic trading. Algorithmic trading, if you want to get history on algorithmic trading, I'd really recommend this book Quants by Scott Patterson. Also The Man Who Sold the Market, it's about Renaissance Technologies, so obviously the most profitable quant shop out there. And yeah, basically you can get computers or write code that will trade, that will profit for you. And guess what? The benefit of hiring computers to trade for you rather than additional traders is they're much easier to manage, they're cheaper, and they can be more profitable because they tend not to react emotionally. But what you find is they just tend to provide a slightly different return stream. So again, you would end up with this sort of diagram. I'm going to do exactly the same. So 10 algos, 100 algos. And yeah, you would expect your profit to increase linearly as you add more algos, because 10 times the algos can run 10 times the money, and so you get 10 times the fee. But again, what you find again is that diversification benefits tend to fall away, while adding additional algos could be a lot cheaper than running and adding additional traders. In the long run, they might not be as profitable, or there's kind of less algorithmic traders out there that can help. So yeah, again, you tend to find that this is really profitable in the short term, and if you're a specialist, but over the long term, if you add too many algorithms and dilute your return streams too much, then your profits can fall off a cliff. So using code as a form of leverage is also mentioned again in Naval Ravikant's book. So yeah, you can also apply that to the financial markets and hedge fund managers. I definitely saw a lot of hedge funds in my time applying these three methods. Like asset gathering is the most common thing in the investment industry, because you get paid a management fee on how many assets you've got, so it's always there, temptation's always there. The amount of times I saw hedge funds hire huge amounts of people and end up having to let them all go because they grew too big, or the strategies didn't work well together, or they're hard to manage. And yeah, this one I just mentioned, algorithmic trading, you saw that. I wasn't born in the birth of the quant era, but a lot of the quant shops were kind of spinning out of the investment banks when I started. So a lot of, I guess, traditional hedge funds that did a lot of discretionary trading were very tempted to add in these algo trading pools to diversify and hence gather more assets. But yeah, I think you had to be a specialist to be very successful here, and you had to be an absolute pro. So like AQR, obviously Renaissance Technologies, and the other quant shops around there. The fourth way hedge fund managers make so much money they question life was they use financial leverage. So that's not actually mentioned in Naval Ravikant's book. This is where we kind of depart from his book. But financial leverage is essentially a bank will give you or lend you money to buy an asset for a period of time. So the benefit of that is if you only have a small down payment, you can get massive exposure. So the clearest example of this is your house. You probably only had to put down a small deposit if you bought your house, say like 20%, and then you got exposure to your whole house. So it's a great way of getting financial leverage. Obviously with a house you kind of pay it off over time, but you can also get this sort of leverage on financial products. So for example, you can buy a future on the S&P, and you probably only have to put down sort of 5% deposit on the exposure you get. So you could probably get $20 million of exposure for only putting down 1 million, which meant that if the S&P went up 10%, you would get 2 million profit. So on your actual invested amount, which was initially 1 million, you've made 2 million. So that can be super attractive, and it's a great way to enhance returns, but you have to be pretty confident the market's going to go in your way, because it also amplifies the downside as well. The hedge fund managers almost exclusively use derivatives like this. They only put down small amounts of capital to get huge amounts of leverage, and this is what led to all the problems with, arguably led to the financial crisis, because banks were so levered in this way. I think the ratios were something like, I just mentioned a 1-to-20 ratio, but I think banks were more in the like 1-to-33 plus range. So people were getting very over leveraged. The thing is, if it's going in your favour, it's very addictive. You love to amplify those gains, so people try and take more and more and more, and then it just reverses and everything falls apart, because you very quickly wipe through your margin if you've got that much leverage. So if you're only putting down like 5% margin, then all you need is a 5% move and it will completely wipe you out. So, and 5% moves are pretty common. So very important to recognise you're playing with fire here, but this is how a lot of traders work and how they generate massive returns. So yeah, this tends to be very linear as well. You basically got a gradient of 20x because your returns are amplified by 20 times if you're 20 times levered. The thing to know about this is you're also symmetrical. So if the market falls, let's say -1, you start to amplify your losses as well. So lots of people have been wiped out by this in the past. So the fifth way hedge fund managers make so much money they question life is they harness compounding. So you've all heard Einstein saying that compound interest was the eighth wonder of the world. You've all heard of Warren Buffett, who's compounded his wealth over 80 years or something. Well, hedge fund managers are doing the same, and successful hedge fund managers typically have a very high rate of return, so way over the market rate, which is arguably 7%, let's say, long-term S&P return, and they do this for a huge amount of time. So the stat I've got here is Rentech, so Renaissance Technology, the quant shop I was talking about, compounded 39% after fees for 30 years. So Rentech's graph will probably look something like that. It's absolutely insane. So this is where we're now going into the realm of what I'm going to say is like convex strategies. So strategies non-linear and they're not concave. So concave were the ones that kind of had diminishing marginal returns as we did more of it, whereas this has increasing marginal returns as we did more of it. So these are typically the most attractive strategies, and compound interest is, or the power of compounding is definitely one, and it's because you have this positive feedback loop. So it's because basically you receive interest on your investment, So in Rentec's example, you receive each year as an investor, let's say 40%, and that money gets reinvested. So let's say you start with 100 million, you get 140 million after your year. That 140 million is then reinvested back into the fund, which will probably make another 40% the next year. So you're up 40% on 140, which is much larger. So these are the most attractive type strategies. And there's no real limit to compound interest. Probably the only limit here is time and the rate at which you can compound. So mere mortals, so investors in the S&P expect, as I said, 7%. If you're investing in cash, 3 to 6% long term, you're really going to need to stretch out that time. But if you're Jim Simons and running Renaissance Technology, he's just hacked this equation. And the benefit of convex equations is that they're hard to get going. So here it looks quite slow, but if you wait long enough, you wait like one day and he's compounded a huge amount. So it just builds and builds and builds and takes time and time and time. So yeah, I think Warren Buffett's compounded for the longest time, and that's why he's so wealthy. And he's even more wealthy than Jim Simons from Rentec because he's been doing it for longer. So it shows how powerful time is in this equation. But this is like a fundamental investment principle. It's why you need to start investing in your pension early, because you get the benefit of maximum time. And yeah, it's the first of our kind of convex equations that hedge fund managers are harnessing. Lots of people, including myself, think that or claim that they understand the power of compounding, and yet they do nothing about it. And that's spoken about really well in The Slight Edge by Jeff Olson. He talks about the power of compound gains or reinforcing feedback loops from a more personal development perspective. And I think it's really interesting. I think lots of people, think linearly. They think about, I think the human brain is wired to think linearly. Yeah, that leads to a lot of issues and thinking errors, basically. So the more you can identify these kind of reinforcing feedback loops and benefit from them, the better. So the sixth way hedge fund managers make so much money they question life is they utilize financial instruments called options with this built-in convexity profile. So certain financial derivatives called options, which gives the holder the right but not the obligation to buy a certain security at a certain price at a certain time in the future, basically give you that convex payoff. So I'm going to draw it again. So it's more like this, where you have some market value increasing and you've got this kind of convex optionality on this. And the reason I draw it below zero here is because you have to pay for the option. So it's like buying a lottery ticket, but with much better odds. So people are typically looking in the 1 to 50 range of the payoff. And the way you profit here is you basically have to predict when the market is going to move in a big way. So I don't know if I've discussed this before, but the market tends to move in small amounts, and then occasionally it has this big move. And the big moves you kind of remember, they're all in the news and the paper. You've got Black Monday, you've got COVID-19 pandemic, you've also got the financial market crisis. It's where you get these huge moves, because as we mentioned, these kind of convex profiles only really matter when you get a big value on the X. So you get a big value on the time, or you get a big value in the market move. And then there are a number of hedge fund managers that profit from this type of structure all the time. As I mentioned before, I used to research discretionary macro hedge funds and tail hedging hedge funds, so I was kind of a specialist in this. And definitely experienced the explosive power of these kind of option payoffs. I guess the thing that people really struggle with here and why everyone doesn't do it is because most of the time you're in this pain zone, which is you're losing money, and it feels very frustrating because everyone likes to be kind of winning all the time. And it's pretty painful actually, until you've tried it, to constantly, it's like paying insurance, you're constantly paying money away in the hope that one day it will pay off. But when it does, it's amazing, and you're making money when everyone else is losing money, which means that you can then reinvest into cheap assets and ride the wave back up. So I'm a massive advocate of these sorts of strategies. Really hard to stick with and really hard to kind of understand. It's quite complicated. This is, relates to the Black-Scholes and all the mathematical finance I've been talking about. But really great stuff. Nassim Taleb also talks about it in his book Anti-Fragile. He's got a graph here of non-linearities. I don't know if you can see that. Yeah, he's got a graph here of the non-linearities that occur in the real world. He uses the example of a stone, and obviously the amount of harm inflicted increases non-linearly with the size of the stone. So I would really recommend digging into it. So another convex payoff. Really recommend. The seventh way hedge fund managers made so much money that they question the meaning of life is they use content to benefit from networking effects. So what is a networking effect? A networking effect basically means that when they put out a piece of content, let's say one person sees it and they might share it to two people, and those two people might share it to another two people. And what you get is this very quick kind of multiplication of effort. Because you only did that piece of content once and you shared it, let's say, with one person, and then that just gets absolutely multiplied through people sharing it with two people. So that gives you another kind of convexity payoff here, like that, where you basically, over time, if it's a good bit of content, so people do want to share it and people find it valuable, they will share it, and you kind of get this kind of convex payoff as well with no real limitation. So a number of hedge fund managers are really nailing this at the moment. I think a lot of them have written books, which is kind of like the initial form of content creation. So I've got Howard Marks's book here, Mastering the Market Cycle. He's obviously a very famous investor for Oaktree, and yeah, he writes lots of investor letters, which are really good, and obviously has written books about investing. And I'm not sure if he's on social media, but yeah, I'll have to check that out. Obviously, Ray Dalio has written a huge amount of books into a huge amount of content creation, and I think that really helps, you know, the marketing effort of Bridgewater, and probably helps retain a lot of his clients. Bridgewater also do this amazing daily observation email for their clients, which I would say, yeah, keeps people interested and stuck in, and it's a big give to their client base, so really cool. And Stephen Schwartzman as well, another massive hedge fund manager. He's Blackstone, so he's more like private debt, I would say, but yeah, he writes loads of books, he's active on social media. All of this kind of benefits from networking effect, helps their marketing, and therefore increases their profit, because the more clients they have, the more assets they gather, the more fees they can charge. The eighth way hedge fund managers are making so much money they question the meaning of life is that they have been doing what they're doing for a very, very long time. A lot of them have been trading since straight out of university. They've been trading the same markets. They've been staring at the markets for hours a day, probably only sleeping like 4 hours a night. So they live and breathe the markets, and through that, they have honed their skill. So skill is another graph that has this kind of convex payoff, which means that it's hard to get going initially, but then once you're down here and you've got tons of skill, you can make a massive profit because you're very skilled in the future, because not many people have done all this hard work, and you get to this point here. And this is covered off a lot. Daniel Kahneman's Thinking Fast and Slow, and investing and financial markets have this incredible feedback mechanism, because you can make a trade and then every day you're watching the value of that trade and to see if it's made money or not. And people learn very quickly, and people also fail very quickly. But yeah, investing is one of those great kind of feedback mechanism. Particularly if you're a trader and you're trading more on the short term and you have a thesis, you can very quickly get your feedback from the market. And if you do it for a very long time, you become very good. You build intuition, and you can become very kind of talented as a trader. And I think that's what a lot of these hedge fund managers have done. They've been trading for absolutely years. So it's second nature to them. And yeah, the more skilled they are, the more money they make, because they generate more returns. James Clear also talks about this kind of the power of like compounding in habits, because when you start a habit, it's super difficult to get going, but then it becomes easier and easier as your kind of brain gets used to it and you learn it. And yeah, by the end of it, it's not even hard to do. Then way number 9, that hedge fund managers make so much money that they question the meaning of life, is that they are constantly innovating. So the reason why innovation in technology follows this kind of convex path is because that you build on your previous technology gains, if that makes sense. So this kind of is like Moore's Law, where Jeffrey West talks about this really well in his book Scale, about how people actually tend to not understand exponentials very well because our brains are wired to think more linearly, which means that we quite often get caught off guard by, non-linear events. So I like using this at the moment because one of the best examples of where people are kind of not really paying attention to exponentials is the exponential fall in the cost of solar energy, and we keep trying to predict a bottom in that, but it keeps going lower. Moore's Law is another example. But yeah, hedge fund managers are constantly innovating, constantly changing and adapting, bringing on board new trading strategies, which allows them, and dropping old ones, which basically allows them to continually adapt and evolve and build on their successes, which leads to this kind of chart, because if they continue to be successful, they continue to make more money. So there we have it. There were 9 ways hedge fund managers became so rich they questioned the meaning of life. As I mentioned, I spent 6 years of my life researching the most successful hedge fund managers out there, and I met quite a few of them in person, and I definitely gleaned these results from them. However, I haven't applied them all in my life, and I'm trying to apply more of them now, and obviously it takes a while to get going, and I may be doing this for a few years. So yeah, looking to see the benefits of this. I've actually been compounding is one area at least I've made the most of, and also developing skill, focusing in one area has been good as well. But yeah, only really kind of dissecting these methods now. So really hope you enjoyed this video, and if you want to hear more from me, don't forget to check out this one here.